Hi, welcome to Stock Story. I'm Doug Taylor. Glad to have you with me here. We're going to talk today about the first element of stock picking that I usually like to look at, and that's the financial health of a company. It's very important to me to preserve my capital, and to do that, I really need to know that the balance sheet is strong. So I think before we get started, I'd just like to remind everybody that this is for educational and entertainment. It is not financial advice, and you should do your own due diligence before investing, but please take these as ideas that you can maybe look into for your own due diligence. So anyways, if you have a accounting background, this is probably pretty remedial to you. I've done an incredibly simple balance sheet for a very simple company, but I want to use it as a demonstration for those of you who aren't as familiar with it. And this is sort of what a balance sheet of a company would look like. And I'm going to relate it to personal finance as well. So plant and equipment being your house, accounts receivable being your paycheck that's due to you, that sort of thing. So I'll try to tie it in, so hopefully to make it make as much sense as possible. So you take a look at this. There's two sides of the balance sheet. One is your assets, and the other one's your liabilities. And then I break them down into current and long term. So of your current assets, you have cash, accounts receivable, and you get a total for that. And these are the type of things that are going to be liquid within a year, so you can use them as cash. Whereas plant, equipment, some of those things you're going to hold for many years, and they're not actually going to be liquid for you to use against debt or anything else like that. So in this particular case, I just gave this business $100,000 in cash, $50,000 in accounts receivable for $150,000 in total current assets. On the current liabilities side, I give them $10,000 in accounts payable on bills for equipment or whatever supplies they need to run their business, and then some short-term debt for something that's a little bit bigger than just buying supplies and that, and I gave them $50,000 for that. So in the end, they have short-term or current assets of $150,000, and they have current liabilities of $60,000. This means on the short term, they're very liquid. They have plenty of money to cover their short-term obligations, and so they're in a pretty good situation. For an individual, this might be their cash in their bank account. The accounts receivable could be their paycheck that's owed to them because they've worked for 2 weeks but they haven't received it yet, and that would give them their total current assets. And then the accounts payable and debt would be things like their credit line, credit cards, things like that they owe, balances that they owe off of that. Now, on the longer term for the company, I've put plant and equipment together, but in some businesses, a lot of businesses, this would be a lot more detailed. There'd be a lot more information on it, but I'm just doing this as a simplicity thing because as an investor, I just mainly want to know the ratios between debt and assets and see what really the equity and book value of the company is worth. So the plant and equipment, in this case, I said $1 million. This is probably more like a house in Vancouver. Anyways, and in this case, they have debt of $500,000, and we'll say that $500,000, if it was a personal finance situation, it would be your house worth $1 million. You've paid off $500,000 of it. You got $500,000 left in debt, and so that would basically be it. So when I total all the current assets and long-term assets, I get 1.15 million. And in this particular example, and then I take all the debts, all the money that's owed against those assets, I get 560,000. So if I subtract the debt from the total assets, it gives me the equity or book value of the company. And in this particular case, with very simple numbers, it's $590,000, which is the book value. So if you were to own shares, if there was a certain amount of shares, you divide that total of 590,000 divided by the shares, and that would be at that existing moment not thinking about any new money coming in from operations or whatever, that would be what the book value of the company is. And if it was liquidated in theory, that's what you would get. That's what would be given to debt holders and then shareholders after the fact. Now, this can vary, but in most cases, I want to see good, strong equity. And it's always great to find a stock where the stock price is actually selling less than the book value. If the company's even doing half decently on the earnings side point, overall, the company should grow. And if the company grows its equity or its book value, then eventually, somewhere along the line, the stock value should go up. So that's the thing. And if you look at equity or book value, you might want to say on your own personal level, it would be your net worth after you've taken the debt to your house and the credit cards and everything, took it off all your cash and that, whatever's left over is your net worth. So that's sort of how we do this. So I'm going to give you some examples here. I'm going to compare, this one here is Air Canada. And you can see right here, it shows its net current asset value. Actually, I was going to go back one thing. There's one thing I meant to say. One of the things I want to know is the current assets to the current liabilities. In this particular case, it looks very able to look after its short-term obligations. I also look at current assets versus the total liabilities. In this particular case, it's maybe a third of it. This is not highly unusual. It is nice, though, to find companies that do have their current assets are actually higher than their total liabilities. That gives me a real strong sense of safety on my capital. But it's not the be all to end all. I also want to know the equity or book value, what that is in relationship to the assets, because that tells me how much of the assets that they own. In this particular case, it's not half, so it's not a super strong balance sheet, but it's not a bad one per se. But it's nice if at least half of the assets are owned outright towards equity. So anyways, I head back there now. So this is Air Canada, and you can see right now the net current asset value, the current assets do not cover the total liabilities. But the interesting thing is the total assets it turns out negative. So that's an issue. And these are all on Guru Focus, and I will leave a link to a review I have on this website, on my website, stockstory.ca, that reviews Guru Focus, and you're welcome to try it out. I'll also leave a link in the description that sends you to a free trial of Guru Focus if you just want to go there and check it out on your own. Anyways, you're taking a look at the cash to debt. It's about half. I like it. I can settle for half if a company's got a long-term history of doing really well. Right now, Air Canada is doing beautifully on its earnings. It seems like it's growing. A lot of good things are happening that way. But it has been spotty over their history, and therefore this is a fairly weak balance sheet. You see the equity to asset, it's not even 1% of their total assets that they actually own. So from a financial standpoint, if things weren't going as well, this company would be in trouble. And I think people always worry about the airlines because the airlines have gone bankrupt so many times, and this is some of the reason why. There is a significant cost to running an airline because airplanes aren't cheap. So a lot of these companies end up having to buy airplanes, which makes it so that their net current assets usually aren't going to be bigger than their liabilities because of the cost of doing that. But you can take a look at this particular one, and then I'll go to Westjet. Now, Westjet has not done as well as Air Canada in the stock market, and their earnings aren't quite as prolific right now, but you see that they actually have a tangible book value. It's not negative. And you can see right here that their cash to debt is almost 1. And this is after a bout of buying new airplanes. So because of that, I feel from their operations, they've shown in the past they usually build it up where they have more cash than debt. Equity to asset is still a little bit low, but I think once again that comes with the territory of airlines in a lot of cases. A lot of the assets, it takes a while to pay them off because airplanes are an expensive business. You'll find that when you get into high capital businesses, sometimes it's a little more difficult. Airlines, though, have been doing really well lately, so I felt I hold this, and I also hold Alaska Airlines, which also has actually more cash than debt at this existing time. And interest coverage is 10. It covers that quite well. So in this case, I've picked Westjet, even though it seems like the price appreciation for Air Canada has been better. I feel more comfortable with Westjet. I feel my capital is safer, and I don't have to keep worrying about it as much because I feel that they are in a fairly solid position, and they're less likely to crash as quickly if things go bad, and I have a better opportunity to get out or buy more or whatever the situation is. So this is a situation. Financial strength, financial condition is a very important part. It's not the only part, as we'll see in further videos or in my stock story page for the 7 points of due diligence, and I'll give a link for that as well. Another couple of examples are Johnson & Johnson and Procter Gamble. And once again, I don't own either because, as I'll show you probably down the line, although they're great companies, right now I feel that the price in the stock market is too much of a premium for what I believe the company is actually worth based on its earnings and its book value. Now, if you take a look at Johnson & Johnson, you'll see they don't have, their net current asset value goes to negative, but their tangible book value is positive. Now, this is a cash flow machine, so they can pay their debts and stuff with their cash flows probably in most cases. But they actually still have, they have equity. Their equity is half their assets, so or a little more than half their assets, and they have more cash than they have debt. They can cover the interest on their loans by 28 times, so they're in pretty good condition there, right? So I kind of like that one when I compare it to Procter and Gamble, which is another great company with heavy cash flows in that. I have chosen not to go with, or I would choose to go more likely to go with the Johnson & Johnson because of this cash to debt, which is 0.05. Now, that doesn't mean that Procter & Gamble might not do better as a business in that. Once again, I'm managing my risk. I'm trying to make sure I don't lose capital. I want to improve my odds for an upside rather than a downside. And their interest coverage is less than it is for Johnson & Johnson. So this is one of the first things I would look at is the balance sheet. So I'll give you, there's one other example here, taking a look at Valiant Pharmaceuticals. And I did not like this balance sheet. I haven't liked it forever. As you can see, it's negative equity. And if you look over here, you can see that the equity asset is very small, like Air Canada's. Cash to debt is very small. I never bought this one, although it did do very well for a while. But if you look at the price, it is now, once they ran into some problems, and their problems were possibly some questionable bookings of revenue, if it was what was coming through. I don't know if they proved it or not. But you can see they were up in the 300s in late 2015, and by the end of 2016 they were under $20 a share. So they collapsed quite a bit. I avoided it, and I don't know if this saved me or not, but by looking at the balance sheet, not seeing something really safe or as safe, I wouldn't buy it regardless of how exciting it looked like the stock action was going to be. I'll just give you a quick example too. I own Bank of Nova Scotia, and if I look at the summary on it, you'll see banks are a little different than other stocks in that, oops, there we go, in that, coming back. There we go. Um, they often have low equity to asset, and the reason for that is, I'll just bring that back up. Okay, they often have low equity to asset because a lot of the assets on their accounts is cash that is deposits from depositors, and so it's also a liability on the other side. So banks are not built to have what look like incredibly strong balance sheets. But what I'd like to look at with a bank is the cash to debt. In this case, Bank of Nova Scotia has a cash to debt of 6 times. So if there was a problem, if there was a panic for some reason that the Canadian banks couldn't cover the depositors or whatever, and there was a run on the deposits, they have 6 times the cash as they have way more than they have deposits. So it does not seem even probable that they could fail as a bank. Now, that being said, I go to Wells Fargo, which is what's considered one of the better running banks, at least until they were caught in a little bit of hanky-panky on how they were booking revenues. But when I go into this one and just bring the thing up, it's kind of slow. Here we go. Okay, they have 0.05 cash to debt. I do understand, I think since the 2007-2008 financial crisis, I believe the banks have paid into a fund with the government that's there to help them out. So that might not be as bad as it looks, but I always feel good because the Canadian banks have always held a really good ratio of cash to debt, whereas this doesn't look that great to me. I'd have to be relying on the government bailing them out, possibly again with money that they've put in, but it just doesn't make me feel quite as comfortable. So this is the first thing I look at in a company. It's not the only thing. You'll see as we go through this, or if you read the article in stockstory.ca, that there are many, many steps that we go through. But financial health is an important one. If it's got a weak balance sheet, then I'm likely to avoid it unless I really, really, really feel strongly about their ability to generate cash through their earnings and operations. And if that's the case, then they're probably a blue chip company, one that has existed for quite a while, has been churning out money like Johnson & Johnson, and I feel very comfortably, or even like Bank of Nova Scotia. They've been operating since the 1800s, and been going strong. So there are some cases where the financial condition might not scare one as much, but I always like to see that it's reasonably good. So anyways, as I said before, on Stock Story, we do have this as an article. It's 7 points of due diligence to prove risk and reward ratio when you're investing in stocks. And it will go through all 7 points here. And I'll be covering these in the videos as I go along here. And so this is the first one. We're doing the balance sheet. So it covers that sort of thing. It uses Apple as an example. It talks about earnings. It goes through all 7, which I will be covering on the videos. Most of what's in the videos would be similar to what's in here. The only thing I would say is there's one area where I actually try to calculate out what I think is a fair price for a stock. I'm just going to scroll down here. I use this discounted cash flow calculator that's in Guru Focus. But the thing is when I used it in this example here, I did include growth. I now don't use growth, and I'll explain that when I get to the video on that. So anyways, that's pretty much it for the financial health piece. Please, if you have any comments, please put them down below. If you like the video, like it, share it with your friends, and please feel free to subscribe to my channel. It really helps me out if you do like this stuff that you indicate it below. And I look forward to talking to you in the next video.